Good morning, good afternoon, good evening to our Chapter Zero members and other non-executive directors. Welcome to this Chapter Zero HSBC fifth and final leg in our five-part webinar series on how directors who serve on the boards of banks, insurance companies, and asset managers can put climate change at the heart of board decision-making. For those of you who haven't heard me say these few introductory remarks, let me just set the stage. Chapter Zero is an initiative that was launched officially almost 2 years ago, but it's actually been in gestation for 5 years. It is a home for non-executive directors who want to learn everything they need to know about climate change in order to make the right decisions in the boardroom and be effective at putting climate change at the heart of business strategy. It is a project that got off the ground thanks to sponsorship from the World Economic Forum, which launched a set of guidance principles in January of last year at Davos. And these 8 principles essentially define what every good board should do. We've been setting up chapters in different countries. We're now up to 19 countries and regions where we have a chapter in various stages of development. Some are fully functioning, such as the UK chapter, which is the one that is hosting this event today. But we also have others that are in the early phases. And if you happen to be in a country that isn't one of our countries, do get in touch because we are very keen to set up chapters in all the key markets. I want to say a special thanks to HSBC. HSBC is a founding, HSBC's chairman is a founding chair of the UK chapter, and HSBC, through his leadership, has also been instrumental in helping us set up a chapter in Hong Kong, in Singapore, and in Mexico. And HSBC has been a fantastic partner in helping us create this webinar series. And this was in response to demand from our members, because around the world we have a significant number of directors who serve on the boards of non-industrial companies, insurance and companies and banks, who rightly pointed out that we had a bit of a bias towards large emitters and that we needed to really get our head around what banks, what financial institutions can do and the influence that they can have on their clients, which is what we're going to hear about today as we discuss physical and transition risk. Now, I just want to say a couple of words since this is our last session of 5, and to say that it isn't our last session in the sense that this is chapter 1 of an important journey. One thing we've learned, there are 175 people registered today, is that this is by far and away our most popular module, and it has been, the replays of these sessions have been circulated widely and listened to again and again, and we've had demand as a result from chapters that are looking to create versions of this for their regions, their markets, etc. So this is not going to end here today. We're going to continue to develop content that is particularly adapted to the needs of directors who serve in the financial services industry. So with that, I want to turn over the floor to our speakers because we have a lot to cover today, and I'll be managing your questions at the end of the session. So do come forward with your questions is it chat or Q&A that we are using, Daniel, for the questions?
I think we use either. So if people are more comfortable, put it in the chat or the Q&A. We always enjoy a very active audience here, so please use either.
Indeed, and so I'll be keeping track of those and then moderating them at the end when all the speakers have finished their remarks. So thank you very much, and over to you, Daniel.
Brilliant, Karina. Thank you. Thank you for hosting this series. As you said, this is session 5 out of 5, and on the slide on the screen, you see what we have covered so far. I think we had a session in July that essentially set out why this is such an important issue. It's obviously a big business opportunity, but more importantly for this session here, it is a significant risk that regulators have picked up. So in the first session, you should have understood why this is so relevant. In the second session, we brought in people from the NGFS, so the Network for Greening the Financial System, and a colleague from the European Commission to set out how policymakers and regulators are thinking about this. And I think we took away that there is a lot in the pipeline, from stress testing to disclosure requirement to taxonomies, that will fundamentally change the way we look at climate risk as a financial institution. In early September, we then had a session on disclosure, and I think the board directors that joined that session were, I think, particularly interested in the perspective from one of the lawyers, who made very clear this is not a choice. This is something that is now critical to be actually a good director on a board. And then at the end of September, we talked about a fairly complex topic. How do you actually do stress testing 30, 50 years out into the future? What kind of questions should you be asking? And frankly, I think today actually is the most complex one, because today we're trying to discuss how do you manage physical and transition risk on a day-to-day basis? As a board member, what kind of questions should you be asking? What metrics should you look at? How do you define risk appetite? And so I'm really, really pleased that we have, I think, 3 exceptional speakers for this. We have Burcu from Moody's, who has a very comprehensive perspective on the different analytics that a large rating agency would put at this. She will speak specifically about physical risk, but also, I think, give us a slightly broader perspective. We then have Ben. Ben, I know well through our joint work for the Bank of England. We work on the climate risk working group there. He leads the analytics and modeling team at Aviva, obviously as an insurance company, very, very experienced how to look at especially physical risk scenarios and how that flows through to capital and other metrics. And then it's a great pleasure to have Bruce Fletcher with us. Bruce, I know from his time at HSBC, who's now the Chief Risk Officer at NatWest. He will talk particularly about the transition risk side, but again, I think about the broader view, how that kind of risk affects a financial institution. And what we ask all 3 speakers today, they should put the questions on the page that they really want to be asked or don't want to be asked by their non-executive directors. So we'll come to this. So I think a really, really important topic. We asked each speaker to talk 15 to 20 minutes. And we also told them that we always enjoyed a very, very engaged audience here. So please be as engaged as you always have been, and put your questions into the Q&A in the chat, and we'll pick them up at the end. Burcu, over to you, and thank you everyone for joining.
Thank you. If we move to the next slide. I just want to give an overview of, I guess, the context of the organization I'm also working on. So a lot of you would recognize Moody's Investor Services, the credit rating agency. So I'll briefly talk about how the credit rating agency is increasingly looking at climate risk in their credit analysis as to the rated issuers. I also sit in the Moody's Analytics, which is really an integrated risk management solutions company. So over a year now, we've been also engaging with our clients on climate risk and the quantification of climate risk as it makes sense to their financial analysis. But also because I referenced some of the partnerships that we have, we in the past year had majority stakeholdership with climate companies such as Vigeo Eiris on ESG and climate transition risk is concerned, and 427 on physical risk, which I'll talk a lot about their capabilities, but also globally in China. Sintao is also a major stakeholdership we had in China with regards to ESG. So I'll try to give an overview of how in each company we're really focusing heavily on climate risk and why, and where we see in the future certain challenges and also how to go about maybe fixing them, right? If we go to the next slide, please. So as I said, physical risks are extreme weather events, what we call acute climate risk, right? And also chronic, gradually evolving climate or physical risks. And when we say transition risk, it's really about us taking an action now up until into the future to transition into a low carbon economy. And when, I think in the previous sessions, we highlighted the importance of scenario analysis and how it may translate into the economy and the financial impacts, but I'll focus more on the credit risk impacts as well as the portfolio impacts. So in terms of when we think about a firm's financial analysis. We look at obviously very into their creditworthiness and how it may result in an asset value or loss valuation as we think about climate change. But not only that, because that's typically what we call the standalone risks or firm level risks, but we also look at like portfolio impacts. So we think that climate risk is a global risk. So it should have certain implications as to correlations and concentrations. So we do actually look as a company into the portfolio impacts of physical and transition risk channels as we go out to different time horizons. So I think it's important to note when we say climate change, we really need to think about the horizon in mind, medium, long term, to really understand how these metrics really play out. So the choice of metrics, the choice of scenarios, the way they impact your portfolio or assets need to be put into context as to time horizon. And I'll refer to how rating agency is looking at it, as well as how we as Moody's Analytics, together with the affiliates, are also looking at this. If we move to the next slide, please. So on the rating agency side, there have been extensive publication on this, and they admittedly say that they find very high relevance with climate scenarios and climate risks as to the credit analysis that they conduct. And that's because they anticipate a pronounced decarbonization trajectory, as well as an increasing, more frequent and volatile extreme weather events in the future, which will impact the rated issuers. So they do this under the light of scenario analysis, so nothing is probabilistic. So there are only possible outcomes, and under certain selection of scenarios, they'd like to see how certain sectors and facilities, as well as like firms, will get impacted out of this. So for example, in carbon transition risk assessments, they use the IEA, International Energy Association scenarios, and they look at the current profile. They look at the preparedness of the issuer itself in terms of the response to climate, as well as under different scenarios highlighted there, what are the potential impacts as to the certain revenue and cost implications that translate into credit risk or credit worthiness. And on the physical risk side, again, is scenario analysis, and it's a single scenario analysis for the next 30 years. The reason for that is a lot of the climate change is locked in up until 2050. So due to historical emissions, as much as it sounds depressing, there's actually a certain magnitude of, carbon dioxide in the air that we won't be able to get rid of up until mid-century. So as a result, when it comes to the next 30 years, there's all locked in impacts of physical climate risk. So they assess again the rated issuers under that scenario to actually see up until next century the preparedness for physical risks as to the rated issuers. So that's, I highlight intentionally because I'm going to make reference to it as well. So that's very much aligned with the view we take on the affiliates as well as Moody's Analytics side as well. If we go to the next slide, please. We also looked at the task force for climate-related financial disclosures to see where we are in terms of the disclosures are concerned. And I think there are certain metrics that are reported quite extensively, like the physical risks, as well as certain carbon pricing as to energy companies. But it's really important to note, and I think for the audience here, that there's very, very few companies out of the 3,000 companies we looked at quite recently that there's an established process to talk about climate change, to talk about climate risk in the light of the board members. So that's quite interesting. And on the second note, there's very, very little number of companies who actually introduce climate risk and climate change into their financial planning. And the third part is really about engagement and enhancement due diligence, which is, I think, a proactive way of acknowledging there is climate risk and doing something about it, right, with regards to your company's operations. So I think that's quite tells us that everything is at infancy stage. I think a lot has been done on TCFD, but where we are today, I think there's a long to go, which was also acknowledged by the PRI, who also did a survey back in July, looking at all the kind of members that they have, that scenario analysis and TCFD disclosures had these kind of weaknesses. So I think there's a long way to go, but I think it's better than a few years ago. But I think key message here is like, we have a lot to do if we're taking a serious action towards managing climate risk and introducing that into our board and financial planning. If we go to the next slide. Thank you. So I will focus on physical risk, but I also wanted to take a step to kind of reflect on transition risk assessments as well. I think there's a lot of information out there when it comes to transition risk assessments when it details about exposures. So when we're talking about carbon emissions that the companies have and scope 1, 2, 3 emissions and how they're managing these emissions, I think there's a high degree of choice of metric when it comes to carbon analytics or carbon accounting. But I also highlight that there's a lot of work going on with regards to carbon transition preparedness and governance, as well as the opportunity. And I highlight the opportunity because I think it's good to look at where you are in terms of the issuers' emissions and what they're doing about it. But I think it's important to note that climate does present opportunities. So in that context, we're doing a lot of work in terms of looking at, you know, EU taxonomy and identifying 72 different economic activities, and also green products and services, because climate is, yes, at risk, but also presents an opportunity for firms. So it should be reflected in the transition risk assessments of the companies. The second one is really on governance. We mentioned the TCFD. We also think that it would be good to also make some assessments in terms of action towards climate or transition. So we're looking at implementation, reporting on TCFD to really say that, you know, this is the current profile, this is the intended action, but is the action following what is said? So we're trying to put a lot of that to test. And the final part is like physical risk assessments, very similar to the transition, is like a management score in terms of how is the company building resilience and adaptation towards climate change. So it's, I think, as important as reporting carbon metrics to really identify governance and opportunity around transition risk. If we go to the next slide. On the physical risk side, I think it's really important to note that physical risk needs to be thought into multiple climate hazards and how they pose a current and future climate risk in the companies, in the assets that you hold, as well as the countries that you may be exposed from a supply chain perspective. So I highlight this because I hear this a lot that, oh, depending on where we are located, there's X number of climate hazards we're exposed to. But I kind of stressed here that I think we're a global system where supply chains tend to be quite global as well, that I think it's important to look at climate risk and different hazards across multiple dimensions, identifying the supply chain risks, as well as the customer demand. So how would the physical risk associated with these hazards really expose your clients, as well as supply chain, as well as the climate hazard exposure? So we think that it should be taken into account in terms of holistically in these dimensions. On that note, I think there are also additional kind of side effects each hazard has as well. So I'll give you one example on wildfires. They also end up having wildfire smoke, which is a factor that we are increasingly looking into incorporating. So while the climate hazards could be core, I think it's important to also look at the second order effects of some of these climate hazards as well. So that's something that we're doing work on. If we go to the next slide. This is I've made reference to when we were talking about the credit rating agency, and pretty much on our 427 and the way we assess physical risk, you'll hear a lot about the IPCC RCP scenarios. So those are climate models and scenarios trying to identify temperature trajectory out into the future under different scenarios. So here we'd like to highlight, when it comes to physical risk, there is a locked-in level of physical risk that we're going to live up until mid-century. So the second part, the observation we're making, is when you compare the RCPs themselves, they are so spread within their kind of resultant outcomes that we actually find it that there's no point actually comparing the RCPs. However, if chosen an RCP, it makes more sense in terms of how the outcomes may range within that RCP when you look at into the future. So on that note, we're kind of continuing to assess physical risk in terms of the RCP 8.5, which is typically the business as usual scenario till mid-century because of that locked-in effect. But we're also trying to distill how the range of outcomes may play out from now till the mid-century, which is, I think, quite useful information if you're doing stress testing, if you're trying to assess the medium to long-term goals when it comes to physical risk. So in order to identify the severity, I think it makes more sense to really create a range within an RCP rather than comparing the RCPs themselves. So that's something that we totally believe in. If we go to the next slide. And then I kind of asked this fit for purpose test purely because I think there was a discussion in the previous session about scenarios. Everything about physical risk or transition risk is under scenarios. So I think one should really pose the question about the purpose about some of these scenario and scenario modeling. I think there was a mention that there's a wide range of scenarios and wide range of models that are in place. I'll give you a very quick example. For example, the MIS carbon transition assessments use the IEA scenarios, and the purpose for that is like for the sectors that they identified as really carbon intensive, they find that to be appropriate. So I think it's worth, depending on the exercise or the analysis that you are trying to do, it's important to ask about which models when it comes to physical and transition risks that I should be using in terms of scenario analysis. So for example, when it comes to physical risk, you require a location-specific assessment. So as a result, we use GCMs. But when it comes to transition risk, I think I've seen different versions in terms of a very sector geocentric integrated assessment models. For us, we're doing actually an extension of those models to actually go into firm level. So one conclusion I have here is like there's a widespread of use in terms of IMs, but it's worth pointing out that if you're really trying to branch out, do a firm level analysis, you really need to extend it to cost and revenue implications on the firm. So I think it's really important to note that there will be data sources or models needed in order to do that. So while it's a good starting point, I think it's really important to extend the analysis in IM space, which NGFS is also very much tied into to do. And on the macroeconomic, I heard a lot of references in the previous session about this as well. I think macroeconomic traditional modeling does not necessarily incorporate any of these climate metrics. So I think one takeaway I take is you really need to extend and enhance that modeling in order to reflect into the physical and transition impact and also the resultant loss and asset valuations of the models you use. Because macroeconomic scenarios also assume that there will be no fundamental shifts, so they assume a long equilibrium. So you have to do a lot of work in terms of enriching those models. In all, I think time horizon is a good question in terms of the purpose of these models and how they inflict into the analysis, but also the question about how to extend these models such that I can use it in the financial variables that I'd like to start using. So when it comes to risk quantification and reporting, I think it needs to be purposeful in terms of which models to choose, and it's not that straightforward. If we go to the next slide. So some of the key considerations, if you're starting on the journey or if you're in the middle of the journey, is like really ask about which climate risk I'm dealing with, but also the data sources, the data granularity and coverage. So I highlighted, for example, it doesn't really tick the box if you choose one metric. It, I think, needs to be much more granular than that. For us, we're looking at thousands of data points when we're trying to carry out some of this analysis. So I think the data granularity and coverage is key. Multiple climate hazard dimension I mentioned. I don't think there's one, two dimensions one should look at, but also in the context of supply chains and customer response. I mentioned a lot exposure, but I think vulnerability, implementation, and preparedness is also key. So they can be a little qualitative in terms of metrics, but I think they're really worthwhile to have in order to have a specific firm level or asset level scorecards. And the second point is really about how to bring physical and transition risk together, because they don't exist independently, and how to do that. The final point I make is like, this is really not a probabilistic analysis. Yes, we're trying to come up with certain credit ratings or credit metrics, but there has to be some measure of probability or volatility around these measures as well. So the outcome is not definite. So as a result, we do think that any measure or any metric should have a range and should have some volatility around this. So even if you arrive as an implied asset value or earnings volatility, I think it's important to kind of assign some sort of a further simulation to really incorporate for these variations. And on that note, I'll pass to my next.
Burcu, thank you. Before I bring in Ben, can I ask you one thing, which I assume some of the directors on the call will wonder. Everybody's very aware of credit risk, credit ratings, because they drive in the end your cost of funding.
Mm-hmm.
How integrated is this at the moment already in the way you assess credit risk and
Mm-hmm.
report as Moody's?
Yeah, I mean, and this is also publicly available, for every credit rating committee, climate risk is actually a discussion point. So all the information that's available and all the analysis that I highlighted there about the issuers is actually being incorporated when they're reviewing those companies. And also on more broadly about ESG as well, which climate is also part of, there has been, I think, 30% of the credit assessments, and this is part of their report as well, that it included ESG risks in the assessment of the credit ratings, and they expect that to be increasing going out into the future. So in all, I think the current profile and the future scenario-driven profile is already in their assessments, but I think going forward, I expect that to also go higher. Hope that answers your question.
Thank you. Ben, over to you.
Thanks very much, Daniel. And thank you very much to Chapter Zero and HSBC for organising this event and inviting me to participate in it. I want to talk a little bit about physical risk today. I don't know whether you, Stephanie, can move on to the next slide. So at Aviva, we're dedicated to protecting our customers' homes and property from extreme weather damage and events such as flood, windstorm, earthquake, and wildfire. And we've got access to very granular level data and sophisticated models that we can use in our underwriting and pricing, as well as for our capital management processes. And these data and models, also enable us when extreme events occur to sort of rapidly support our customers as well at what is very often a very distressing time for people. And what we tend to do is, as well as doing all of that, we also look backwards and look at how our actual weather-related losses compare to what we expected. And that enables us to to look at changes in exposure over time, and it also enables us to look at trends over time. And the charts on this slide are pointing that out. So we've got a chart on the right that's looking at our actual versus expected losses for UK, France and Canadian businesses over the last 10 years or so. And then we've also got another slide looking at combined operating ratio, which is a sort of, for non-general insurers, a sort of a measure of profitability over the last 5 years. And you can see how those are impacted by weather events. As well as on the insurance side, we also obviously invest in assets at Aviva, and for real assets and property, we will, as part of the origination process, look at physical risks such as flooding, coastal erosion and subsidence. So we were already thinking about physical risks today in the way we manage our business, and it's a key part of how we're supporting our customers. Stephanie, do you want to move on to the next slide, please? So I guess if we're doing all of that, what's the issue? Well, I guess that the real issue is that much of that data analysis and modelling at the moment that we do and other insurers do is based on current climate conditions. And we know that weather-related events are going to become more frequent, severe, and clustered, as well as persistent as a result of climate change. And that's not just in a sort of what we call a 4-degree, the RCP 8.5 scenario that we've represented. So it's not just a case there in those more extreme hothouse scenarios, we're going to see that. Actually, even in the less extreme, even in a 1.5-degree scenario where we meet the Paris Agreement, we are going to see changes in sort of physical risks and extreme weather events. So this is something that is going to happen one way or another. It's just a question of how extreme is it going to be. And for our general insurance business, actually that sort of basing things on current climate conditions is perhaps not that bad an assumption, because the business reprices. We basically have annual contracts, it renews annually, we reprice annually. So to some extent we can follow changes in the physical environment over time. However, there is a question about whether CAT models that we currently use, so the catastrophe models we currently use, given that they're calibrated on historical data, whether they're up to date really and capturing those climate trends, which is one of the key reasons why it's important to track sort of actuals versus expected outcomes to make sure you're capturing those types of effects. But notwithstanding that, in the medium and longer term, premiums we're going to need to increase those premiums to cover the risks as the intensity, as frequent weather becomes more intense and frequent extreme weather becomes more intense and frequent. So even if we can capture this through pricing over time, we do expect that this is going to impact the premiums, and that could ultimately hamper our ability to provide assurance profitably to our customers at affordable levels. And that's one of the reasons why we're absolutely very supportive of sort of initiatives like Flood Re that enable people in sort of more flood-prone areas to continue to receive cover. And we think those types of schemes are going to become increasingly important over the years if we're going to maintain insurance coverage across the piece. The charts here demonstrate, very clearly, this is all based on UK government data. And it shows that out to 2040, these are actually 2-degree scenarios. So these are not that extreme scenarios. You could see, it's quite likely you could see sort of precipitation, rainfall increase by up to 60% in the UK. The chart on the right is demonstrating that's not going to be evenly distributed. So there are going to be some areas that are going to be much more affected than others. In some areas, you may actually see rainfall fall. But overall, the average is increasing, and there are some areas that are going to see very significant increases in precipitation. And the UK published data on a whole range of different sort of climate and perils, whether it's rain flow, river flow, sea level rise, and similar data is available that you can look at and track. So Stephanie, could you move on to the next slide, please? So what does that mean? Well, from our perspective, we're trying to think, how can we therefore start to sort of understand those risks? How can we think about how our business is going to be impacted as the physical risks change over time? And in order to do that, we've developed a climate value at risk measure, initially as part of a United Nations Environment Programme task force, which was looking at, got together about 20 large investors to think about how we could improve our climate-related financial disclosures, but also start to develop our risk management understanding and our sort of the risk measures that we have to start to think about the longer-term implications of climate change for our business. And this measure was also developed in collaboration with Carbon Delta, which is now part of MSCI. So they were sort of fintech company, and the aim of the project was really to bring their expertise together with a whole range of asset owners and to think about how we could develop measures, in particular to cover corporate bonds and equity exposures. Now, the climate VAR measure that we've developed enables us to look at the impact of the 4 IPCC scenarios that were mentioned previously by Buka. So we've got the one sort of very broadly a 1.5, 2, 3, 4 degree scenarios that map into the RCP concentration pathways that were talked about previously. And the model covers equities, corporate bond investments, as well as sovereign bonds and all property-linked assets. So we've got very good coverage on the asset side, and it also covers life and general insurance liability. So we built a measure that covers most aspects of our balance sheet to date. With respect to corporate bonds and equities, it's really looking at 3 things where physical risk could impact the valuation of companies. So the first is companies' facilities. So buildings, plants, infrastructure, where physical risk could damage the cost of those buildings or increase the insurance premiums over time. It's also looking at potentially physical risk could impact supply chain effects. So that would impact their ability to produce end products and could disrupt their business. And then finally, physical risk could potentially impact as well demand for products and services going forward, depending on how those risks manifest themselves over time and how they impact the products that a particular company has to sell. In terms of sovereign, sorry, Stephanie, you just flip back. In terms of sovereign risk and sovereign bonds, we use something called the Notre Dame Global Adaptation Index to measure countries' climate change risk. And that's covering both sort of the country's vulnerability and ability to adapt to climate change. And then, finally, and the climate VAR measure that we're using will capture sort of extreme heat and cold, heavy precipitation and snow, coastal flooding, wind gusts and tropical cyclones. So it's covering a range of different perils. And coming back to the point earlier about uncertainty, so, in terms of the financial impact of financial risks and opportunities, we look at both the expected costs in a BAU scenario, as well as a sort of 95th percentile cost, using the output of the models and analysis that we're doing. And that enables us to sort of build a distribution, which we can then, a distribution of physical outcomes that we can then apply and develop for each scenario in turn. So not just the 4 degree scenario, but the 3, the 2 and the 1.5 degree scenario. And so what does that analysis tell us? Well, first of all, you can see from this chart, and effectively you've got sort of 4 bars here. So if you look at the 4 degree bar, where the grey and the orange interlink, that's the sort of the mean impact, if you like, in that scenario. And then one end of the grey bar is a sort of a 95th percentile outcome, and the end of the orange bar is a 5th percentile outcome. So it's giving you a range of outcomes for each individual scenario. And then what you can also see is how those ranges differ in the 3, 2 and 1.5 degree scenario. And what this is showing is in the 4 degree scenario, unsurprisingly, we're talking primarily about physical risk. So the chart on the right shows the split between physical and transition risk. And you've got primary physical risk, and that is dominating. And what that's telling us as well is that really it's that physical risk in that 4-degree scenario which is likely to have the biggest impact on Aviva's business. You know, where physical risk actually not dominating on the insurance side, but dominating really on sort of the long-term impact on investment returns of equities, corporate bonds, real estate loans, and sovereign exposures. And so that is really the driving force behind this analysis. What you can also see is that, you know, in the 1.5-degree scenario and the 2-degree scenario, there is some potential upside, and that transition risk is dominating physical risk, even after you take into account sort of potential opportunities on the transition risk side in those scenarios. So this analysis, you know, we recognise there are you know, limits to this analysis, and you know, number of things that need to be improved, and we certainly expect it to improve over time. But we found it very helpful in starting to think about the risks on our business and how you know, different scenarios could impact our business. And therefore that started to feed into strategy and thinking about, well, how do we want to position ourselves going forward? What commitments we're going to do. And it's certainly telling us that, you know, we need the world to be on a 1.5-degree trajectory in line with the Paris Agreement, you know, for our business long term. That's going to be the most, you know, beneficial scenario for our business long term going forward, as well as for our customers and the world. So moving on to the next slide. So in terms of questions that what questions should you be asking, or what questions would I not want to be asked by board if I was senior management? I think the very first question is, you know, what are the physical risks that you're exposed to today on your business? And how are those risks being identified, measured, monitored, managed and reported upon? You know, it may sound like a simple question, but many businesses are exposed to physical risks today. And, you know, often volatility, you know, your volatility of earnings is impacted by weather-related activities. But it's not always explicitly managed or understood. It's sort of accepted as, you know, part of business or a seasonal variation. Now, that may be appropriate if climate change is static today and that position is static. But, you know, if climate conditions are changing, trying to understand what those physical risk drivers are and how they may change is really
I think we lost Ben, but it looks like this is also his last page. So maybe on that, Bruce, may I bring you in?
Sure. Thank you. Happy to do that, Daniel. And that was a good last page. I could have written it myself. So those are very good questions. I'll endorse them. So thank you for the invitation to be here. As Daniel mentioned, I was previously at HSBC, have been the CRO in NatWest for about 2 years. Previously was the Chief Risk Officer for HSBC's global retail and wealth management business. And at one point their HBEU European operation as well. But actually most of my career was with Citibank, about 20 years there in New York. Just a little bit about NatWest and here, and not to crowd in on the HSBC. Good work, Daniel, but this is a newer focus area for us. And we feel like we're already making some impact and changes. And you may recall that we have a new CEO, Alison Rose, who, amongst other targets in becoming a purpose-led company, set a target for us of having basically reducing by half our carbon intensity of our financed portfolios, of our loan portfolios by 2030. So that's one of the main things that I've been involved in. And obviously the firm has signed up to a range of different initiatives, be they TCFD, Paris alignment, and whatnot. And just to give a bit of hope for those of you on this same journey, that after a year, we were able to see, at least on one measure, looking at the autonomous research rankings that came out, we moved to being 7th out of 44 banks in their evaluation of climate risk, which was quite a significant improvement for us. So I think it shows that you can have real impact when you really start down this path and take it seriously. And then just background from a risk standpoint, we've just completed our first pilot of a stress test on our loan portfolio. It's our first climate stress test that we've done. We focused on a couple of key sectors, obligor level data on larger obligors, as well as a subset of one of our retail portfolios to look at that on a portfolio basis. So we were really pleased to get that done. We've got another test planned before year end. All of this obviously in advance for some of the regulatory requirement around BES stress testing next year. But let's go to the next page. So what is transition risk? Actually, you've had some good descriptions of it already. And I would say as challenging as physical risk is to assess the impact on our obligors, as you've just heard, and there are different methods there. I think it's even more difficult to really assess transition risk of the clients that we're lending to. There are just so many factors that come into play around government policy and regulation, competition, how individual companies within sectors will react, and shifting consumer sentiment. Think about in a somewhat related area, plastic straws, which became really a lightning rod for consumer action, and their preferences changed very dramatically in a short period of time, and then followed in some areas by regulation as well. My general sense is that the banking industry is very clearly mispricing transition risk today. The risks that could be caused by stranded assets, either assets that have a short or useful life. But even if your tenors are short, many of the deals that we do require some form of a takeout of another type of a financing, be it a private or a public takeout. And that, I'll call it that no takeout risk, actually, I think is relatively short for certain types of assets and certain types of sectors, even though we often think about climate change as a risk that actually won't be hitting us for a long period of time. And then there's the greater risk on our obligors that we have to understand, which are the reputational ones. And that comes about through partly from disclosure or lack of disclosure, right? Promising to be climate friendly and then not being climate friendly, so hypocrisy. Those types of things, I think, can have a very significant impact on the companies that we lend to, and can really lead further to changes in consumer sentiment. So I've got a few examples, on this page, but it really comes down to regulation, disruption. There are billions being invested in a whole range of industry sectors on how to reduce companies' carbon footprints, either in their supply chain or in the products themselves in the manufacture, or how they're ultimately used. Just like it's happened in the digital space, the fifth industrial revolution, there will be disruption in the climate space, and we need to understand what those impacts are on our clients. And then there are also liability risks around disclosure, what you disclose. And then there's a next page, if I could change that. There's a depiction here. Some of these were just mentioned. But if you think about the impact on an obligor, the company that you're lending to, there's changes in the regulation, sentiment, disruption. They can either change demand for their product or their costs. And but if they have a good transition plan, their understanding of how their customers will be changing, their preferences will be changing, how regulation will be impacting them, they should have a good transition plan themselves, and they could possibly even create demand, for new products. They could innovate and they could shift their own, product mix. Likewise, their costs could either go up or down, either in an unabated or in an abated type of situation. And then ultimately, from a market standpoint, as you work your way across the bottom from left to right, how much of this can they pass on? If there's a cost impact or a benefit impact, how much of that can they pass on to customers as well? So the trick is for banks, how do you collect this information? How do you gather it? And Some of this, there are readily available data sources on very large public companies that you can get some of this information. And you should be able to get a sense today within a given sector which public companies are more vulnerable or not through this type of a lens or through an existing classification type of a methodology. We're trying to get to doing this at an obligor level, not just for public companies, but to large private companies as well. We're part of an industry initiative with UK Finance and looking at obligor questionnaires and to see if there's something we can do across the industry so that rather than have each bank separately ask a somewhat similar set of questions to every company they deal with and have that company get things from 3, 4, 5 banks, is there some kind of an industry approach that we could do? Because if you think about it as a relationship manager and as a credit person approving that credit, you would want to understand all of these things and their approaches to managing changes in demand and understanding the impacts on their costs as well. One possible way then to use all this information is to come up with some type of a transition score or a rating that you could say this company is either good or bad. And it could be very blunt at this point in time. And I would expect these, particularly in private companies, to be almost exploratory in their initial use, which is why I think we also have to be careful in how we use them. And then if you go to the next page, you can see how we think about all this coming together. And I know you've had quite a bit already. Actually, this is similar to some of the slides you've just seen, and you've had quite a bit coming together on modeling, with the 3 different scenarios which are being used. We think the UK regulators will be using scenarios that are the same ones that we're looking at from the industry, the body NGFS as an example. I won't go into these. The tricky part then really is around modeling the impacts. The first step is expanding the scenario. Those will be pretty gross, but you'll need to expand it based on your models and based on your footprint for your bank. And you'll probably have to do both sector level and obligor level work here, because under the BES scenario, I think they're expecting about an 80% portfolio coverage. You'll have to look at both the physical and the transition risks, the physical risks that we just cover. And the approach that we're using is really looking at how that would impact the assets or the equity of that obligor. Looking at either market cap or property values, for example, in real estate types of deals. And as we build our models with a combination of obligor and sector level data, we're looking at how you then translate those asset value shocks into credit factors. And there are a couple of different ways to do this. You can use kind of a Merton model type approach, which looks at equity value impact on probability of default. And you can do that either at a sector or an obligor type of level. And then all of the, all the feeder models that come into this will have to be modified in some way. Your PD, EAD, LGD types of models will need to be modified. So if you go to the following page here, and this is just one simple kind of a case study. So you saw what that might look like as a portfolio stress test. When you look at a particular type of a company, this type of an approach could be applied to any company. Here is brought out as an example of an energy company. There's a number of things that we can do when we're dealing with obligors, which is the left-hand side. And then the right-hand side are the kinds of things we would expect to see or an obligor could be expected to do. And oftentimes a good place to start is just focus on the most impacted sectors. Not surprisingly, the analysis that we just did, the scenario analysis, came up with pretty much the same impacted sectors that we thought going in, being around oil and gas, transport, automotive, et cetera. Just focus on those and focus on your large obligors with this type of an approach. So if you look at the left-hand side, what should we be doing? One would be to identify the clients that you think will be most impacted, even on some basic type of classification matrix around transition and physical risks. Increase the frequency of your internal reviews of those particular clients and of those sectors. You can expand and incorporate that into your sector reviews. that you're no doubt doing already that today are largely focused on credit risk. But you can bring this in there as well. You can look at then the lending terms, the terms and conditions, the tenors of certain sectors that you're comfortable with, and then ultimately sector level exposure as well on the sectors most impacted. The right-hand side is your credit people and your relationship managers are calling on clients. What you'd be asking questions around would be asking them which are their assets most sensitive to climate change. Which ones are they divesting versus which ones are they investing in? How are they considering abatement for impacts on their transition risks? And how are they diversifying, getting into new business streams? So I think there's quite a bit here that even without a lot of analysis and just using expert judgment, you can start to get into and should be getting into in dealing with large obligors. And then the final set of final page, another set of questions for you. First, the top part really is just some considerations of your own footprint. So climate change will impact geography differently depending on the country and the part of the country your portfolios are located in. That will impact the time frames that you should be considering here. And I would particularly be focused on stranded assets. I personally think the impacts and the likelihood of stranded assets will be greater than we have thought as an industry and will be pulled forward than maybe more we have thought even just a year ago. You'll want to think about then your exposure to the most intensive sectors, and a series of questions down below, would be ones that I think would be difficult for your chief risk officer to answer, which is today, what is your exposure to transition risk? How do you measure it separately from physical risk? What are the key sectors that you're worried about? Which obligors within those sectors are doing better than others in managing transition risks and will do better over a 10 or 15 year time horizon? What's the methodology you're using to gather information from clients, or the approach you're using to gather the information, and the methodology to translate that into some type of a transition score? How much is that empirically based or just based on expert judgment? And then how are you using it? How are you embedding it into your risk management framework, particularly your credit framework, and then incorporating it into pricing, deal structure, tenor concerns as well. And then finally, I think there's quite a bit around accountabilities and responsibilities. I should have mentioned up front, I'm the designated individual that the firm has volunteered, that the PRA has asked for, to be the senior manager responsible for the financial risks of climate change in NatWest. But there's a whole string of accountabilities and responsibilities behind that across the first and the second line. How much have you embedded that in the management of this risk across the firm? And Daniel, with that, it was a quick gallop through, but I wanted to make sure we had plenty of time for questions. Back to you.
Okay, I'll jump in here now. I haven't received any questions from this group, so I'm going to start, and that might prompt some of you to come up with some of your own. I have a question for Bruce that goes back to your opening comment when you said that NatWest had recently announced a target of halving the emissions of its client base by 2030. Did I hear that correctly, Bruce?
That's right. Yeah, that's
okay.
Right.
So just from my own background, formerly in the investment sector, there were big arguments about how you actually measure that. And I mean, 10 years out is not very much time. I say this as someone who serves on the board of an oil and gas company, and I was intrigued by your case study of an oil and gas company, where I think you certainly mapped out the thinking that goes on very well. Now, is it that you would, because some of what you described was very qualitative. It was about assessing the sort of the big changes that your clients are going to put in place and are going to deliver visible results over an extended period. But if we're talking about 2030, are you talking about measuring the carbon footprint of those clients today versus the carbon footprint of your portfolio of clients in 2030 and capturing a 50% reduction? Or is there a way of translating all of these qualitative measures that your clients are making in order to feed into that 50% cut?
Yeah, thank you for that. Yeah, it's I think you're right. Well, first off, I should say we've taken on the ambition and can't measure what the current impact of our portfolio financing is today. So we knew it was an ambitious statement, and we're still in the process, frankly, of developing the right methodology and the way to think about this. But the improvement would come from a combination of changes in our obligors and changes in the way and where and how we finance, which gets back to the whole magnification opportunity that we have as an industry here to make a significant change. I do think for public companies, there are quantitative types, as you would know, quantitative types of measures today that we can take into account on their carbon footprint and impact. What we're trying to do is capture that methodology and approach and extend that into the private sector and even into the consumer, for example, the residential mortgage portfolio. So I would expect that to be more quantitative. And there are quite a few third-party firms stepping into this space now and able to provide you with data, either at a sector or in the residential mortgage space, using energy efficiency ratings as an example, to get there. And I think the challenge for us is not how we do this punitively, but how do we actually educate the companies and the consumers that we deal with to help them transition. The more we help them transition, the greater, I think, impact we have, and the greater we can achieve our 50% reduction goal.
All right, thank you for that. Question for Ben. Your opening question: what physical risks is the business exposed to today? I want to share with you an incident that affected my oil company a couple of years ago in respect of physical climate risk, and then to ask your advice on how that can be properly mitigated. So we operate, among other things, a series of refineries, and we have invested extensively to lift generators above ground and build retaining walls and basically protect these assets from severe weather events. And of course, the 1 in 100-year event happened. This was in the city of Livorno on the west coast of Italy, and there were fatalities. There were literally dead bodies floating in the streets, and the municipality requested that we knock down our retaining walls, allow the floodwaters to come into our refinery. We had emptied our silos preventively in anticipation of the storm, and we were asked to absorb the floodwaters into our silos. And that, of course, had a dramatic impact on reducing the damage to the city. But guess what? We were not able to get insurance coverage for the damage that we suffered because we had positively, taken down our defenses in order to assist the city. So I guess my question is, given the systemic nature of physical risks, given the pressure on companies to take measures unilaterally to make their operations more resilient, what is a reasonable strategy for companies to ensure that those resilience measures actually provide the protection that they paid for when what is happening beyond their fence line is not adequate, and we're in fact operating in an environment that is not resilient? And so, as an insurer, what advice would you give to a client that is faced with that kind of circumstance?
Okay, not an easy question. I think that one of the things that, I can say that we've learned from an Aviva perspective is, I think you're absolutely right. Physical risk is a systemic risk. And, if you get into those hothouse scenarios, there's very little that you can do to actually mitigate those risks as a company or a society, because everything is correlated and highly correlated. So I think that one of the ways you do need to mitigate risk is actually the physical risk is really to is through sort of using your influence as a company, and big companies like Aviva or large energy companies, etc., to make sure that the policies that are being implemented by regulators and others and governments are helping to ensure that we're on the right path, on that 1.5 degree path as opposed to a 4 degree path. And that's something that we're actively doing at Aviva. So we're advocating for governments to take aggressive action from a policy regulatory perspective to make sure that we've got the right, we're on the right path to hit 1.5 degrees. Now that can't save, it's not going to save you completely, but it's one of the key things that you can do to manage that systemic risk, I believe. And then on top of that, we had also looked to find ways to, as a company, we're a big investor, so looking for opportunities to invest in climate resilient infrastructure, whether it's flood defences or other methods that are providing support to whole regions. Again, is another way that you can look to sort of more broadly tackle these types of issues. And we certainly also work with individual clients to think about how we could build back better after flood events, etc., to think about how you can make your operations and facilities more sustainable and more resilient to these types of events. But you're right, you can only go so far with that. And I think you have to look more broadly if you're going to tackle the bigger issue, including just thinking about as well where you put things in the future when you invest obviously in new buildings, etc., or new facilities, where you are going to put those in the future, and making sure you're taking into account not just the physical risks today in a particular region, but actually the physical risks in 20, 30 years' time, depending on the life of that plant or facility or infrastructure.
Thank you. Thank you very much. That actually is the main takeaway, is that, sorry, Stephanie, are you putting your hand up? That it might be easier to relocate a plant than to convince a regional authority to invest in proper flood defenses. I hope that's not the answer, but all right, we've got actually a bunch of questions that have started to come in, so I'm going to take you through them. I'm going to start chronologically in the order in which I received them. So what are the 2 or 3 KPIs that we as board directors should be looking at? So in other words, what's the dummy's guide to all that rather complex stuff we've just heard now? If we were to go into our boardrooms tomorrow and we have to pick 2 or 3 big questions, if each of the 3 of you were now serving on boards, which are the first 2 or 3 questions that you would put to your fellow board directors and your management as the starting point? All right, there are 3 of you, so I'm going to give you 1 each.
Maybe I'll jump in. I think the first has to be around stress testing, because we have an immediate short-term deliverable here, and I think the question's got to be around how are you incorporating both transition and physical risk into the stress tests that you're running? How granular is that information? Is it obligor or sector level? And what does your model suite look like, if you will, both your existing models and the new models that you'll be using to actually achieve that? I think the second thing, and I think it might have been one of your questions, was around how are you embedding climate risk assessment into your existing risk management framework? Because climate risk will impact every single risk that you have: credit risk, market risk, conduct risk, reputational risk. So it's got to be, how far along are you in embedding it into your risk framework? Those would be my 2 votes.
Okay, Bruce, if I can give you a follow-up on that one.
Mm-hmm.
I say this as someone who's, again, on a board of an oil and gas company. Would you say, so when you do stress tests, you have your base case, your better case, and your worst case. Would you say that your worst case on the adaptation side should be a 4-degree world, but your worst case on a transition side should be a 1.5-degree world? In other words, for an oil and gas company, they should be stress testing against a 1.5-degree world, as currently does not happen, because people are doing 2 degrees, not 1.5 in the oil and gas sector. What would you advocate?
You've stumped me there, I have to say, Karina. I think it's a great philosophical question. I'm going to have to give some thought to afterward. I don't know if
okay,
Ben,
homework.
for homework. I don't know if Ben from a another industry perspective would have an answer, but I don't want to throw Ben under the bus either.
I mean,
Okay, Ben, your turn.
Okay. I mean, certainly, I think when we're looking at, you know, what's our baseline, which I guess is a sort of the same question backwards, really, which is thinking what do you measure against? Then certainly, currently, when it comes to physical risk, we are thinking, you know, what's the likely impact on our business relative to current conditions of, you know, climate change in a 4-degree scenario, whatever it may be. And similarly, when we're thinking about transition risk, we're saying, you know, what are the costs relative to today? So you look at, you know, if carbon prices increase, you know, just assuming that cost is going to flow through to the business in each of those different scenarios, depending on how the carbon price is going to increase in each situation. Now, in some ways, those two things are slightly contradictory because, you know, if people were pricing rationally for climate risk, then you would expect that they would, to some extent, either they're pricing in some of the physical risk already, or they're pricing in some of the transition risk. And to some extent, what we're doing is saying, well, we're going to assume they're not pricing in either of those risks at the moment. So we're going to look at the impact of both from a sort of a baseline perspective. And I think that is actually probably a conservative place to be, but it's probably not that far away from the truth, because I think there's still a lot of evidence that people aren't pricing in climate risk in a sort of not only not pricing it in, but not pricing it in a coherent way when they're thinking about transition and physical risk at the moment.
Okay, Burcu, you get your question.
In terms of what I would ask, yeah, I mean, very much covered most of the thing, but one thing I would ask is like, and I think we lived it with COVID, is I would definitely look at my established model landscape and ask the question why, you know, COVID failed all of them. And the reason I say that is like, if you were to find the answer to that question, and I think you would find yourself a good path in terms of modeling landscape. And I think Bruce mentioned that as well, because I think in the way we look at credit analysis or scorecards, etc., we tend to be very financial variable oriented as well as looking backwards. But I think what climate modeling and how it quantifies into financial risk really demands is some real true economic understanding about the uncertainty in the future and quantifying that into the asset values and the business risk associated. And so for me, I think the main question I would ask is like, how do I redesign my modeling landscape so that I can capture forward-looking dynamics such as climate, as well as any other non-financial risk or emerging risk into the future. So I think that's the key question there, whether it's stress testing or whether it's some other purpose. I think that's the weakness or the gap in the industry as a whole.
It's interesting that you bring up COVID as an example. Let me give you another little anecdote from my company again, right? We have long experience of pandemics because we were in the middle of the Ebola one. So literally in January, when the first signs came, we put in place this extensive system and, you know, protected the staff and the supply chain and all of that. So we haven't lost anybody, but guess what? Our pandemic preparedness plan did not protect us from a gigantic collapse in demand, right? And so that's the systemic impact of a pandemic. And so it begs the question, and we had a number of questions from participants just now, is if this is systemic in nature and the mitigation, I don't mean climate mitigation, I mean the mitigation of the systemic impact, lies in acting collectively to influence decisions by government on climate preparedness, just as we would have been far better off with a little better pandemic preparedness. What role do we play? What role does the insurance sector play? Does the banking sector play to galvanize a common position of the business community vis-a-vis government to invest in preparedness? Because we're talking about corporate preparedness, where each of us individually invests within our fence line, but that doesn't give us the wherewithal to do that next level of preparedness that will that will protect us from those effects that we simply cannot control. So I'd be interested in, that question came up repeatedly actually, so I'm not just making it, it's not, I mean, I happen to share it, but have you got ideas yourselves about what you, through your institution or through your trade association or through other initiatives, can be doing to address this wider systemic issue?
Happy to have a go at that. And I think that we certainly see engagement. So as an insurance company, we're a big asset owner, and we certainly see engagement with investee companies as a key way in which we can help support to a low carbon economy. So we're investing across a wide range of sectors, and we can use that, and we have voting rights in large numbers of companies, so we can use that engagement to help to transition the real economy as a whole, and that goes well beyond our our sort of just our sort of narrow insurance focus, I guess. And I think the other thing that we've done is we've joined something called the Net Zero Asset Owners Alliance. It's a group of large asset owners, and working with them together to try and come up with a set of targets for the right trajectory that companies should be on in terms of the carbon intensity or the alignment of their assets going forward in order to meet that sort of net zero by 2050 target, as well as to think about how you can engage together with companies to be more effective in influencing that transition. But I do think it is also about in using the influence of companies and groups like that with governments as well. So it's also about how do you engage with governments, because ultimately a lot of this is going to come down to governmental action and policy action through a wide range of sectors.
Thank you.
Maybe I could come in on that. I mean, I think the biggest impact, one of the biggest impacts we can have is working with government towards solutions. And a number of banks in the UK have been involved with the PRA on the Bank of England. I've actually got their webpage here, but it's the Climate Financial Risk Forum, and they published a suite of guides to how to manage this risk. Daniel was very involved in that. I sit on that committee as well, representing NatWest, and I've seen industry collaboration spawn from that in a whole range of areas, and our engagement with government and the regulators really has stepped up a notch. So I think the more we can encourage an industry-wide approach, this isn't a competitive situation. We all need to work together, and I'd say also the more we can do this with the government and regulators, I would really encourage all the people on the phone to take that kind of an approach. I think that's the way we magnify our efforts here.
Thank you, Bruce. That was exactly the answer I was hoping for. We have another question, which is now more practical, more back to what we can do in our boardrooms as opposed to how we can change the course of governmental decision making, which is who in the organization should be responsible for the management of these risks. Is there, at the moment, I mean, it's not necessarily clear, particularly to banks and insurance companies that are just starting out in this area, who's the natural owner of this agenda, or is it necessary to create a head of climate risk? How would you advise?
Maybe just because I commented on that earlier. I mean, I think ultimately risk the management of risk is a business responsibility. It's the first line. It's people that run businesses, that deal with clients. I think they've got the first, in my mind, the first defense against managing all risks, including this risk. I think at the moment, because it's new, there's a bunch of more technical risk management people involved in doing it, like you've got represented here with Bursu and Ben. But I think, and we'll continue to be involved in supporting, I think, our respective organizations. Ultimately, it's the first line. It's the CEO. It's the business heads, it's relationship managers, but open to other points of view.
Spen here. I mean, I'd agree with that. I think that we at Aviva, in terms of the supervisory statement and allocating senior management function responsibility, we've initially assigned that to sort of the CROs within the business, and for the reasons that Bruce has said. So this is relatively new. We think that risk has got that sort of broad perspective, and they can help to implement and integrate climate risks into the risk management framework. But ultimately, that's with a view to, once that project of embedding has completed, and towards the end of next year, then to hand that over to the first line where that risk ultimately needs to be managed. And if you're going to integrate this into all parts of your business, which you need to, it's going to have to be owned by the first line, whether it's CEO, CFO, going forward.
Okay, thank you. The questions are now flooding in and we're going to run out of time. I'm just going to try to do as many as I can. How would you see financial market infrastructure, capital markets infrastructure providers, payment systems, exchanges, clearinghouses, asset servicers, et cetera, assessing their exposures, not just for themselves, but as businesses, but for the clients who use their service? What is their responsibility as enablers of those business models who are contributors to systemic climate risk? And I think you've sort of touched on this already, but that's, I think it's diving deeper into all of the people in the ecosystem that are providing these services that are connected to what you do. Any thoughts on that? Okay. I'm gonna go to the next one in that case.
I'm happy to be
maybe I'd just say there's lots of specialty types of different firms out there. I think everyone's got to interpret it for themselves. Everyone will have a role to play. Everyone will get asked by a rating agency or an ESG type of firm, and they'll get a questionnaire on what are they doing to reduce these risks based on their role. So I think the generic answer is they better be prepared to answer the question because there's lots of those questions are being asked, and we're getting more questions every year.
And Karina, just one thing to add on this. I think in particular when it comes to disclosure and information, these market infrastructure providers are particularly important. So IOSCO, which is essentially the regulator of exchanges, is pushing hard on disclosure requirements on exchanges. And so you will see more and more change of what companies have to report to be actually able to list on large public markets. And you're on mute.
Oops, we are coming to the end. We have room for one more question, and then we're going to have to wrap up. So actually, I've got so many. I'm so sorry. All of a sudden, they're all flooding in. All right, we have one here on Scope 3 emissions. How are you approaching that, given there are concerns about double counting in your modeling? Are you taking that as a must, or how do you approach it?
I mean, maybe on our side, I think I made reference to it with regards to VGO Iris, right? So Scope 3 is fundamentally part of our framework as to the carbon footprint. And that's very much aligned with the TCFD, and there's going to be also further guidelines on Scope 3. Because I think unless you really understand the value chain all the way down to Scope 3, it's very hard to make any kind of analysis as to the cost and revenues. So, I mean, that's our approach on VGO Iris and the overall ESG. Maybe to refer the previous comment as well, I think there's a question about how applicable across board, but TCFD is really financial disclosure across for all firms, including non-financial firms or exchange, etc. Right? So I think that should be enforced going forward.
Any other views on Scope 3 before we wrap up?
It's Ben. I mean, it's clearly a very important issue if you're going to have an appropriate assessment of the risk of any particular company, or as well as the contribution that any actions you're taking to sort of ensuring a smooth transition. So I think, though, at the moment there are still issues around the sort of the quality of some of the data and the consistency and comparability of some of the data. So I think we should all be making efforts to incorporate Scope 3 effects into the modelling that we're doing, and temperature alignment type metrics. But you just need to be a little bit careful about how you do it and making sure that you don't get ahead of yourself in terms of the data not being there to really support the analysis that's being done.
Okay, and Bruce, anything to add before we wrap up? No. Okay, Daniel, I think we suddenly had a burst of questions, but and they were all really good ones. So thank you very much, and now over to you, Daniel.
Yeah, thank you also from my side to the speakers for the good questions from the participants. For me, there are really three main takeaways from this. First of all, For this to work, you need to have an integrated approach. It doesn't work if you put it to the side of your risk management approach. It has to be integrated. The second for me is data is key, and we can make this incredibly complex, but data isn't the full answer. I think when you take the scope 3 question that just came up, of course it's important to understand all of this, but what you really want to understand is how different companies and how different customers perform in different scenarios. And in the end, a lot of this becomes quite common sense. You need data, but don't take it as an excuse not to get started, because the engagement with these transition pathways is more important than getting every data point right. And the third topic, and actually the most important for this audience here, is it starts with the tone from the top. This topic will only get embedded in an organization if the tone from the top makes it an important topic. And so I think it's great to have this group of directors here, because you need to ask these questions to make sure the organization understands that this is important. So thank you, everyone. I think we had now five takes at this in different angles. I hope you found this useful. As we said, this is recorded. You find it on the internet, on the Chapter 0 site. As Karina said, this is not the end. This is the beginning of a much more exploratory journey of climate risk. And I just want to thank everyone for the time and passion and commitment to this agenda. Thank you.